Hey, good morning, everybody. My name is Stu Turley, President and CEO of Sandstone Group. And I'll tell you what, I have a fabulous conversation coming up for you. I got Rob Turnham, and he is the CEO and one of the best managers I know out there. And some people call him the best dressed guy out on the planet. And I have known Rob for a long time. And got a great natural gas discussion coming up. Welcome to the show.
Thanks, Stu. Great to be with you.
I'm probably going to be the most fun host you've had in a while. So let's just have a little bit of fun down there.
Great.
How's everything down there for Goodrich right now?
Well, good. I mean, we're 99% natural gas. Obviously, gas prices have risen dramatically. Our volumes are rising. Our costs are dropping. And therefore, we've got real margin expansion that's really favorable right now. So, all is well. We got a great balance sheet and growing both production volumes and EBITDA pretty dramatically. So, everything's going well for the company.
I was taking a look at your Q2 financials and not only having free cash flow, you and I have talked, I believe it was over a year ago, and your management of aiming for that free cash flow, your cost protections and making sure that is all down has been really, you got a history.
Yeah, thank you. It's, it's probably because the Haynesville is the most predictable basin we've been in. If you drilling, at least in the core of the play where our acreage position is, if you drill and complete a well a certain way, it typically comes in within a very narrow range. And so our ability to model the future and predict where we're going is as tight as we've seen it over the 26 years we've been public. Nice. So if you look at what we have guided to, which is why we're comfortable in giving guidance further out into the future. We're talking, we generated about 24.5 million of EBITDA in the second quarter. If you take our production volume growth in the third quarter and the fourth quarter, that EBITDA should go up to, call it, in the 34 million range in the third quarter, up from 24.4, and then in the $40 million range for the fourth quarter. If you start annualizing those quarterly numbers, you're looking at a company that's trading at current enterprise value, of about 2 times annualized fourth quarter EBITDA, and that is ridiculously cheap. Not just compared to our gassy peers, but compared to anyone in the E&P space. So it's our job to get out and kind of tell the story. But you mentioned that cash costs going down. Our margins are likely, they were 63% in the second quarter. That number is probably going to go north of 70% on realized price in the fourth quarter. So, things are working very well. You can't get punch drunk and drinking the Kool-Aid because you always have to worry about downside protection. But with the balance sheet in such a good shape, we feel like we're in a good spot.
Your stock ticker is GDP, if I remember right.
That's right.
I'll tell you, that's kind of a nice stock ticker. Everybody talks about GDP around the world and everything else. How did you get that stock ticker?
Well, at the time we went public in August of '95, it was available, and it at least started with a G, and so that was that had a nice name awareness or symbol awareness. So it made sense. Now sometimes you'll see on our company news there'll be some GDP report from Europe. That will hit our news feed, so it's not always exactly accurate, but it's at least something that people can remember.
Oh, I know. I'm from Oklahoma and Texas, so sometimes it's a little hard. You're over in the Haynesville, so you got a little bit more of a good thing going on there with memory. I mean, plus you got all that. So your investors, I'll tell you what, should be really interested in your long-term forecast, because before we got on, we were talking, I'm very extremely bullish on natural gas. And as it's going to go to LNG, Bloomberg released this morning, Rob, we were talking about supply and demand and what's going to come around the corner. And I mean, this is absolutely fabulous for you. I mean, there is some great takeaways coming away for you, aren't there?
Yeah, the regional benefit of being in the Haynesville is obviously the demand pull from the Gulf Coast. It's not just the 11 to 11.5 BCF a day that's being exported through the LNG terminals, but it's also 7 BCF a day going to Mexico. So there's a real that's the best gas basin and the closest in proximity to these real demand centers, and we just think that just gets better and better. You combine that with very low storage numbers, both here in the U.S. We should enter the withdrawal season well below the 5-year average. And you look at Europe. I know you pointed this out. Europe, is dramatically below the 5-year average, and they're relying on Russian gas, which is not a great situation. In addition to LNG exports, so we should be faced with a really interesting winter. And people think $4 gas, boy, it's so much better, and it is.
Right.
But prices could certainly go higher. You combine that demand with the fact that there's real pressure to not grow supply here because investors want to see you live within your cash flow, don't grow for growth's sake. And we're growing, but we're not growing for growth's sake. We're growing because we're growing EBITDA, we're growing PDP value, and therefore the enterprise is going to be growing prudently. So there's real pressure to keep supply, kind of don't outspend, so which is going to keep supply flattish, which is where we've been. And you've got this really shortage on the storage and a real demand pull. So it's setting itself up really nicely.
That is absolutely fantastic. One of the things I've really enjoyed about the Goodrich Heritage is the strong commitment to the shareholders, all shareholders or stockholders of the company. You have a strong commitment, and I really, good management, good numbers. And I like your constant, steady turn there. Some of the things that just your company in the Haynesville, and how is the Marine Shale and the Eagle Ford and the Tuscaloosa compared to the Haynesville? Are those even mattering?
No, they don't compare, frankly. The Tuscaloosa Marine Shale, or the TMS, will have its day in the future, and we still have 30,000 net acres there. There's just a lot of oil. And the last time we or anyone else were drilling and completing wells there, the technology was much poorer than it is today. Okay. So much easier to drill those wells once we go back and apply more modern completion recipes. We're pumping 4,000 pounds per foot of sand in the Haynesville over 100-foot intervals with a lot of fluid. It's breaking up the rock much more efficiently and recovering a much higher percentage of the gas that's in place.
Right.
Well, when we were back in the TMS, we were completing frac stages, much wider interval and less than, and call it about a half of the proppant. And if you do regression analysis and you start to look at what's really driving the results in the Haynesville, it's really proppant per foot to EUR, or estimated ultimate recoverable reserves. Right. And it's interval spacing. How tight is that frac interval stage length? Because what you're trying to do is rubbleize the near wellbore, and the tighter the interval, we have 40 perforations over that 100 feet, and you blast it with a lot of water and a high proppant concentration. We're getting 30% of the gas that's in place, whereas in the first generation in the Haynesville, we were getting about half of that. Wow. Actually less than half of that. So that's what's really revolutionized the Haynesville, and that's why you're seeing these really high volumes, really low per unit costs, and recoveries at a much higher clip. So the TMS will have its day. It just doesn't compete on a return basis to what we're doing in the Haynesville. And the same as the Eagle Ford. Our Eagle Ford is probably tier 2. It's just undeveloped acres. It's held by production. We'll have a time in the future to go back there. But right now, when you're generating 100% IRRs on drilling Haynesville wells, there's no reason to go anywhere else, but just keep your eye on the ball, keep spending money in that play. And we're generating, as I said, somewhere in the neighborhood of 65, 70% cash margin, or return on corporate returns. We were 45% rate of return in this past quarter. that ranks second among all public E&P companies. So it's status quo. Keep your eye on the ball and don't get distracted by going somewhere else and trying to prove something up. Let's just put the numbers on the scoreboard.
That is, you are not normal. And I mean that in the best compliment.
Thank you.
Because a lot of E&P companies did not give back to their shareholders because you've always had fiscal responsibility. You've not been on that treadmill. And I respect that.
Well, look, 6 of us own 54% of the stock, and every dollar we're spending is coming personally out of our pocket. So there's a real shareholder-friendly approach to our company, which is when you have a good thing, let's just keep pounding away at it and put those numbers on the scoreboard.
Yep.
And as we do, we think the stock will trade better because you can't trade it 2 times your annualized EBITDA. That's ridiculously cheap, in particular when your balance sheet's in good shape. So we're not going to get distracted. There is a lot of M&A around that basin, however, and we continue to participate in bolt-on acquisitions that make sense for us. So you're expanding your drilling inventory. Good. Under that scenario, we basically don't pay much money up front, but we'll commit to drilling wells. They stay in for a real small overriding royalty interest, and they get more money by virtue of us drilling wells than they would if they sold the acreage in an undeveloped status. So we'll continue that, and we'll entertain anything else that comes our way. But a lot of opportunities to expand our footprint.
This market has just gone bonkers with also the ESG movements and everything else. And, it's kind of fun that you guys are not having to flare like out in the Permian and all those other, you have takeaway. So
yes, that's right.
You do not have to flare.
Yeah, we don't turn a well on until we've hooked it up and the pipeline is taking the gas. And so that's a real benefit. Plus, we're right in the middle of a substantial amount of takeaway capacity, which we have plenty of room to grow in that basin. And the gas that we produce is pipeline grade gas, so you can crack it and turn it into the pipeline right there. So we're drilling wells within existing facility areas. Sometimes you have to expand your facilities because these wells have such high volumes. But plenty of ability to sell that gas immediately at the wellhead.
You're probably one of the most unique positioned E&P public out there. And Rob, I am so happy for you on those
Thank you.
Things.
Appreciate it.
Good management, good numbers, good shareholder and stockholder investor management. I really like to hear that, especially with ESG. You guys tout that no flaring. That was not a loaded question, by the way. I kind of knew that before I asked you.
Yeah, well, it's in our slide deck, and we think it's important. When you really are talking about climate change, and we really feel like there needs to be an intellectually honest approach to climate change, which is, it's we're all in this together. We should limit our footprint, our carbon footprint. We should do everything that we can to minimize our emissions, but there needs to be a cost-benefit analysis to the benefit of people here. And there's so many people that are energy poverty that are cooking inside with dung or wood, and they're dying at early ages, and they need energy, and it needs to be cheap and reliable. And but on the flip side, we need to do our part to minimize, emissions. And I think if we'll take that cost benefit analysis approach and we focus on the benefit to the most people, then I think we can get to a point where we're using carbon, storage and utilization in addition to renewables and whatever that's an all of the above approach. Because, even the IEA, which is pushing renewables dramatically, even their forward-looking models suggest that by 2050, even though electric vehicles are going to penetrate the market in a much bigger way, in addition to wind and solar, they still think that the demand on gas is going to be significantly higher than it is today. It may not be market share, but it might be, but it's going to be, we need more and more gas in the future to electrify and heat and use for the most people in the world.
You are spot on, and it is fabulous. I got a research team of master's students working on some stuff for us. And the more we go greener, the more fossil fuels we use. It is not a, oh, by the way, it's either oil, gas, or supposed renewables. It is both. And I mean that you cannot go to green nirvana without oil and gas.
Yeah, no, for sure. And I think gas even wins out when you're comparing it versus oil, just because of the application that we have. Our greenhouse gas emissions in the U.S. are down 17% over the last, 15 years. And none of the other nations in the Paris Accord have done that well, even though they've, documented what they want to do. So I think, we're doing our part. Now, the U.S. only emits 15% of the world emissions. China's twice that. If China and India don't follow suit, then we can do all that we could ever want to do here, and it won't make a bit of difference. And so it does need to be, worldwide cooperation. But, why not adapt to climate change? It always changes, versus going a really expensive mitigating strategy where you disrupt so much in the world and you keep people who are really in energy poverty from getting to that point where we are in the developed nations.
What's funny is right now we have Africa and we have some of the disproportionately impacted countries, not only just, areas. And you are right on with your long-term plan. Natural gas is the lower cost a lot of time than these other forms out there. And then coal is taking a big head start right now and increasing again because some of the costs on the renewables can't catch up back to coal.
That's right. I mean, China talks about reducing emissions and going green, but they're building coal plants. India, again, such a huge portion of their population is starved of energy, and you can't build a wind farm, or a bunch of solar panels in the middle of the desert and expect to really, take those people in a cost-effective way to where they need to be. So it's definitely, long term, we're going to have all of the above, and why not have all of the above? And then let's adapt as we go. And a lot of times we're building things in environmentally sensitive areas. Maybe you can't do quite as much of that in the future.
Right.
You have to be cognizant that you might have some change in weather. So it's the science that people talk about. There's a great book by Coonan called Unsettled with a question mark. I don't know if you've read it. It's, he was an Obama administration member, MIT, Caltech, super bright, super scientific analysis of where we are. And a lot of the models that we're using to predict the future, when you go back and look at it 2 or 3 years ago, was it accurate? It wasn't accurate, yet we keep following the same models and the same algorithms. So taking a full, all of the above approach, doing the right thing, figuring out how best to reduce our carbon footprint makes sense. But let's just don't do things drastic that are going to increase the cost of energy to people around the world.
I like your opinions and the Goodrich philosophy on all of this. You've got everything running down the right road, right attitude, good management, good numbers. I'll give you the last word, Rob. What do you want to tell anybody that's looking at GDP?
Well, it's a pretty easy story to follow and understand. It's one basin where you have consistent well results that has as good a cash margins and rates of return as any play in the world right now. I mean,
Right.
The oily guys in the Permian get a lot of attention, and rightfully so. It's the best oil basin domestically, but their returns aren't as good as what we're seeing in the Haynesville right now. So I think what you'll see us continue to do is just keep putting the numbers on the scoreboard, keep growing EBITDA, grow your proved developed producing value. The company will be worth more in the future, but you got to be cognizant of commodity prices, where they might go in the future. Always protect against the downside. Keep your balance sheet in good order. And if you look at GDP, I think we're as well positioned as anyone to really succeed over the next couple of years.
I'll tell you what, thank you for stopping by our video podcast, and it's on our app, and we will have all of your contact information out there in as we roll this out. And I hope you don't mind stopping by in the future again. So
sounds great, Stu. Great to visit with you.
Bye-bye.
Bye.